Morning, everyone. I'm Ben Mohr. I'm Marquette's Director of Fixed Income. I'm thrilled to be here today. Thank you so much for coming to our symposium. It's nice to see a lot of familiar faces and some new ones as well. We are very fortunate to have secured Mohammed El-Erian to talk to us about fixed income today. So I thought that we would talk about the very exciting and fascinating field of machine learning and artificial intelligence. Now, during Greg's panel earlier, Olga talked about the importance of technological development and the growing importance of machine learning and AI in the overall economy, as well as in portfolio management today as well. So it behooves us as investors and fiduciaries to know more about AI and machine learning and how that's being applied in portfolio management today. Now, by show of hands, how many of us use machine learning every day? Okay, that was a trick question. Every single one of you should be raising your hands because between online shopping, Google searches, we are actually, in fact, all of us today using machine learning every single day. By show of hands, how many of us know how machine learning works at a high level? Again, trick question. All of you should be raising your hands because, in fact, all of us know as investors, and I'll tell you why, how machine learning works. We'll go through that. So hopefully my talk will support and encourage your knowledge of that. So shall we begin? Okay, this is one of my favorite movies from 1991, Terminator 2, when I was in junior high school, when sentient machines take over the world, complete with lasers and explosions. You can't have a Hollywood blockbuster these days without lasers and pyrotechnics, even in 1991. So we'll go through the history of machine learning just very quickly, then we'll dive into what machine learning is, and in fact, you'll know how it works. Next, we'll cover why we want to use machine learning for investing, what its obstacles are, and how it's being used in asset management today. Then we'll close with future trends. Now, we've come a long way. Machine learning and AI has grown exponentially. Some of you might remember back in 1997 when Deep Blue beat Kasparov in chess. Google released their first self-driving car in 2009. Watson won Jeopardy in 2011. Since then, it continues to grow. Today, no less than 10 asset managers are actively using machine learning in their investment processes. We've met with AQR, Citadel, a couple of the big hedge funds right here in Chicago to go through these processes, and we'll go a little bit more in depth a little later. Now, right now, I want to make a distinction between AI and machine learning. AI is when the machine performs tasks intelligently. Machine learning is actually a branch within AI where the machine can learn on its own without supervision. I'll just pause for a moment here. So I've got 3 cartoons. This is the best. They're going to get progressively worse. With our low interest rate environment today, here's an excuse you can use with your children, grandchildren, nephews, nieces. Maybe that's a bad idea. Maybe just as a joke. Why are we hearing so much about machine learning today in the last few years? What's making all this possible? The answer is big data. And I find this statistic just fascinating. Can you believe it? 90% of all data today was created just in the last 2 years. That's mind-boggling. Here I want to make a distinction between big data analytics and machine learning. Big data analytics is discovering hidden patterns and extracting insights from volumes of data where you need significant computing resources. Machine learning is learning without explicitly being programmed. Big data is enabling the improvement of accuracy of machine learning and its predictive powers. And as computers become more powerful, machine learning can become more useful and accurate. Now, the moment you've all been waiting for. We'll take a look at what machine learning is, and you'll realize that you actually already know how it works at a high level. Behind all the smoke and mirrors, it's just probability, statistics, and regression, but amplified. Here's the basic building block of machine learning. Everyone here knows about simple linear regression. You all use it as investors. This equation, y equals alpha plus beta times x. you all know alpha is the excess return of your strategy versus the index. Beta is your strategy's sensitivity to the index. X is the index's returns. Y is your strategy's returns. The way we use this in regression is if we have all the history of X's and Y, all the data, we can plug them into the computer. We can get the average alpha and beta. Then when we look forward into the future, each real-time X that we get in, we can plug that into this equation times beta plus alpha we can use to predict Y. So the regression equation helps us predict Y using future X's. In machine learning, this is the very core. Here's an example where we want to use machine learning. We'll take a look at using it for facial recognition for driverless cars, and then how to apply it for investing. Here we're training the machine to recognize a cat. We give it the Y, we tell the machine this is a cat, and then we give it the various X's. It could be pointy ears of a cat, the whiskers of a cat. Machine learns this and learns that this is a cat, these are the characteristics. It then stores those alpha and beta coefficients. Now, an important point I want to make here is, while a machine can recognize the pointy ears of a cat and the whiskers of a cat, it can't recognize the feisty behavior of a cat. Now, the amplification. This is the deep neural network. A deep neural network is a common machine learning framework which has hidden layers. And each of these nodes is that linear regression equation that we looked at earlier. Each of these nodes interact with each other, and it captures the second, third, and fourth order patterns for better accuracy. Okay, so now we're going to learn how machine learning actually learns, and we'll train the machine to figure out what a cat looks like, then start recognizing different animals. So here we're going to teach the machine using the neural network that here's the Y, this is the cat. We show it, it recognizes the X's, the pointy ears, the whiskers, and it stores those alpha and beta coefficients. Then if we show it a different picture of a cat, we ask it, is this a cat? The machine takes in those X's, it recognizes the pointy ears, it recognizes the whiskers, and it can tell us that, yes, this is a cat. Now, what if we show it something that's not a cat? We show it a dolphin. The machine takes a look, it doesn't see pointy ears, it doesn't see whiskers, it goes through the deep neural network, it can tell us that this is not a cat. Now, how about using this for asset management? We do something similar. We tell the machine all those various X's, we can go as far back in history as we want. We can look at historical price-earnings ratios for valuations of certain stocks, debt to EBITDA, the leverage of certain companies, GDP, the economic growth of certain economies, and interest rates, 10-year Treasury yield. And then on the Y side, this can apply to literally any asset class. This could be the stock price, this could be the price of a bond, this could be commodities, currencies, could be their price levels, it could be their magnitude of changes in price. Now the machine learns and it takes in all this historical data and it stores all those alpha and beta coefficients we looked at earlier. Then the next step, we can use the machine to actually start making investments. So here, we're using the machine going forward. It's collecting all the real-time, real X's coming in real time, today, tomorrow, going forward, the price-earnings ratios, the leverage metrics, so on and so forth. And the machine can start trading for us. And again, this could be any asset class, stocks, bonds, commodities, currencies. Now, imagine this is always turned on. There's that step one where we train the machine. The step two is where we use the machine to actually do the investing for us. Imagine step two is kept on all the time. The machine can keep taking in those X's and keep making trades for us. But even more powerful than that, imagine step one is also kept on all the time. So the machine keeps learning. It keeps taking in those new X's and it keeps refining those alpha and beta coefficients. It keeps learning how the markets move and makes better and better trades. So it's always learning, always recognizing new patterns, always improving its accuracy and doing this in an unsupervised manner. This is a lot of power that we as investors can harness. Okay, this is the second of three cartoons. I'll just hang back for a minute for you to take a look. So I just got married this time last year, and I'm still getting the hang of this. Okay, all of you being skilled investors, you could probably tease out what the benefits here are. Enhanced alpha. Better systematically discern alpha versus beta than humans can. Recognizing more patterns than humans can. Reducing fat fingers. Learning faster than we can. This can, again, apply to any asset class, stocks, bonds, commodities, currencies. Which is why Ray Dalio, the founder of one of the biggest hedge funds, Bridgewater, recently said that he believes 40% of all jobs in financial services are going to be replaced by algorithms over the next 20 years. Now, not to worry, the financial services industry is very broad. This is not just asset management. This includes transaction processing, banking, insurance, tax services. And we're also seeing machine learning jobs on the rise. So we might surmise that a lot of these jobs that get displaced, the people become machine learning trainers, where they're involved in setting up the machines and training the machines. Now, one thing for sure is the jobs that require client interfacing, management, leadership, the jobs that require advice, consultation, a personality, a personal touch, those are going to be safe. Now, the benefits of machine learning sound great, the enhanced alpha, but it's not without its obstacles. There are key characteristics that differ between using machine learning for facial recognition on the left there versus using machine learning for investing. The first is the patterns are stationary when we're using machine learning for facial expression or driverless cars. My face is always going to be roughly the same, 2 eyes, a nose, mouth. I'm going to get older, but it'll be 2 eyes and so on. But then for the financial markets, financial metrics keep changing all the time. Case in point, price-earnings ratio we talked about earlier used to be averaging in the teens. Now they're averaging in the 20s. They could go to the 30s or 40s in the future. The 10-year Treasury yield back in the early 80s because of the oil crisis was actually at 15%. Just yesterday, just this morning, it's dropped down to 1.5%. So these relationships and patterns continue to change, making machine learning for investing harder. The second is the high signal to noise ratio when it comes to using machine learning for driverless cars. It's fairly easy to, even with a blurry photo of my face, you can pick out the 2 eyes, the nose, the mouth. But when it comes to financial data, it's tough to discern what's a signal and what's a noise. When it comes to valuation multiples, who's to say we should use EV to EBITDA, price to earnings, price to sales, price to book? Some of those are noises, some of those are signals. Same with GDP. Should we look at the US GDP or should we use the world GDP or include China's or Japan's GDP? Some of those might be signals and noises, so it's going to be tough to discern. And then finally, there's no market competition for facial recognition for driverless cars. Tons of market competition when it comes to achieving alpha in the financial markets. How has machine learning done so far? Very well, in fact. This index here, the EuroHedge AI Hedge Fund Index, includes about 10 funds that use AI actively for their investment management. It's a fairly small sample, but in the last 10 years, we can see it's actually done quite well. It's beat out stocks, it's beat out bonds, both in terms of overall returns and efficiency, the Sharpe ratio. Now, there's a caveat here. It's still quite volatile, so this is still sort of a new burgeoning area. But we can see there's some low correlation versus stocks and bonds. Another caveat I want to mention here is this index is not investable and it's not representative. It's still very much the Wild West when it comes to machine learning for investing. In the top left here, we looked at some of those hedge funds, AQR, Citadel. They're using machine learning for things like shrinkage methods for fighting against overfit, developing better covariance matrices. But we want to proceed with caution when we're investing in this area because some companies are going bust. Sentient Investment Management was a fund that was launched in 2016 but went defunct in 2018. They used this genetic algorithmic approach where they had multiple virtual trader bots, each considered kind of like a gene where if they do well, they continue to evolve. The ones that don't, they discard, but they went defunct. As a next step, our thinking is that more and more mainstream asset managers, like your Crescent, like your Income Research and Management, Mackay, Symphony Asset Management, are going to start using machine learning more and more in their processes. And in fact, one of them already has. Just a couple months ago, I did an on-site due diligence session at Eaton Vance in Boston. For their municipal opportunity strategy, they're using machine learning to read all the local newspapers in all the counties and cities of all 50 states to extract insights on the water authorities, the bridges, the tollways for investment insights. So it's already being used. Okay, I'll give you a moment here to take a look at this cartoon. A lot of us have smart speakers at home. We at home, we use it. We have this all the time. We tell Alexa to play classical music, and sure enough, it'll play classic rock. Thing's got a mind of its own. Okay, this is only the beginning, we believe. Machine learning is being researched. There's a lot of research being done, and it seems like every day new research is being published on things like return forecasting using machine learning, risk modeling using machine learning, and natural linguistic processing using machine learning. And a lot of investments have been put into this field as well. Steve Schwarzman, the founder of Blackstone, one of the biggest private equity firms around, recently anchored a $1 billion donation to MIT to study machine learning and AI. So I'd like to conclude with giving you some key takeaways. The overarching theme here is that machine learning is becoming more and more important within asset management as well as the global economy. It's big data that's making machine learning possible. You already know how it works. Machine learning is just regression. We can use machine learning to better achieve alpha, faster and with fewer errors than humans can. But there are key obstacles. Those non-stationary data relationships I talked about earlier, the high noise versus signal, immense competition. And this is the Wild West. You got machine learning funds that are coming and busting. Different managers are using it in different ways. And the future trends, we believe, are that more and more managers are going to incorporate machine learning into their processes. Eaton Vance already has, and perhaps launching dedicated strategies as well, and perhaps overcoming those above-mentioned challenges. So right now, I'm delighted to introduce Greg Leonberger, our Director of Research, and invite him to the podium. He's going to talk to us about recessions and inflation. I'll be around if there are any questions. And thank you. You've been a fantastic audience.